Hello, I'm Equtiy from Minc and today I'll be talking to you about fundamental analysis. Fundamental analysis is a technique that aims to determine a security's value by examining the variables that determine value, such as current and future earnings, interest rates, and risk variables. After this analysis, if a security's intrinsic value is determined to be more than the prevailing market price, then it makes sense to purchase the security, believing that over time the security's value and market price will converge. Fundamental analysis aims to analyse a company and ask such questions as: is the company making a profit? Is their revenue growing? Is the company able to repay their debts? And is the company in a strong position relative to its peers? The first place to start with fundamental analysis is to look at the economy and the various macroeconomic factors that would influence the company you are interested in. It is then important to review the industry within which they operate, considering factors such as market share, industry growth, competition, and regulation within the industry. From there, the analysis becomes more specific, where it's important to consider a company's position within the industry, management skills, shareholder rights, and the financial and information transparency. And finally, fundamental analysis will look at the three important financial statements: the balance sheet, the income statement, and the cash flow statement. From these statements, a large number of financial calculations can be performed that will assist in obtaining a valuation for the company. I will discuss three commonly used financial ratios and how they can be used to assist your investment decision. The three items I will discuss are the PE ratio, ROE or return on equity, and dividend yield. No single tool will be enough to give you a buy or sell recommendation by itself. However, each figure will give you a greater understanding of where the company fits within the industry and will assist you in determining the potential of that investment. I'll start with the PE ratio, which stands for price to earnings ratio. In simple terms, it is the price of a share divided by the earnings per share. There are two alternative definitions of PE. One is trailing PE, which is the current market price divided by the most recent EPS, and the other is leading PE, which is the stock's current price divided by the next year's earnings expected. A higher PE means an investor is paying more for each unit of net income, so the stock is more expensive compared to one with a lower PE. Just like a lower PE means you are paying less for each unit of net income. Normally stocks with high earnings growth are traded at higher PE. It's usually not enough just to look at a PE of one company. It's important to look at a company's PE compared to the industry it's in, the sector it's in, as well as the overall market. This will provide you with an idea of how the company you're interested in compares to other companies within that sector. Also, during a bull market, PEs will rise due to investor sentiment. The same company in a bull market will trade at a higher PE than it would in a bear market, simply due to market sentiment. A second tool of fundamental analysis is ROE, or return on equity. It measures the amount of net income returned as a percentage of shareholders' equity, or simply, ROE shows how well a company uses investment funds to generate earnings growth. To arrive at the figure, you divide shareholders' equity into net income. A higher ROE indicates that shareholders are receiving a greater percentage return for the money they are investing. As with most financial ratios, ROE is best used to compare companies within the same industry. It's important to note that not all high ROEs make good investments. Some industries will have a high ROE because they require no assets, whereas companies such as oil refineries require a lot of capital, therefore they have lower ROEs. A final ratio we'll look at is dividend yield. It is the ratio that will tell you how much a company pays out each year relative to its share price. It's calculated by dividing the annual dividend by the current share price. Historically, investors prefer stocks with higher dividend yields. However, this ratio must also be used in conjunction with other assessment tools. A stock may have a high dividend yield, but its share price could be dropping, while the dividend is staying the same, hence the high yield. But the company may not be able to afford to pay this dividend going into the future. In general, older well-established companies tend to pay out a higher percentage than do younger companies. For a value investor who is looking for dividend income, the dividend yield is a useful measure. In summary, the three analysis tools I have discussed are commonly used within the investment analysis process. It is important each ratio is not used in isolation and is used to compare the company with its peers, with the industry, and even within the market as a whole. Thanks for watching my webinar on fundamental analysis, and stay tuned for more just like this. I'm Equtiy from Minc and I hope to see you again soon.